There are many ways to record consistent profits from trading or investing. You simply have to find your own way. The rules of your trading system will define how you interact with the market. It may seem like a very small detail, but in fact it's the definition of the game. Your entries, your exits, your trade management, and your risk strategy should all be contained in your system rules. That's why today we'll discuss about the process of building your own successful trading strategy and the questions you need to ask yourself in order to create a consistent trading system. First question: are you a market specialist? The first decision to make when designing your strategy is to decide which currency pairs or stocks you will be trading, because not all systems will work on every market. The question becomes, which type of a trader are you? You may decide between two basic trader profiles. The first is the market specialist. As a specialist, you will concentrate on one market. Some traders begin trading with the belief that they must trade every market available, and that simply is not the case. Market specialists are some of the most profitable traders on the planet, and many of them have a high win rate. This comes with the understanding of the market and having a relationship with it, the factors that affect the market, and the method for determining the mood of the market. There are many successful traders who trade only one market. Perhaps you only want to trade the Euro JPY, for example. If you decide to be a Euro JPY specialist, you will learn the complexity of the pair. Each market has a personality, and as a Euro JPY specialist, you will learn the personality of the Euro and the JPY. You might also learn the correlations associated with a pair, when the pair is reacting in an unusual way, and so forth. As a market specialist, you'll become familiar with the market. You will know what it does around the non-farm payroll report. You will know the effects of the interest rate announcements for your market, and you will be aware of what the currency pair is likely to do. So it's a combination of technical with fundamental analysis. Market specialists will sometimes use different trading strategies on the same market. Perhaps you decide you want to become a market specialist for a stock, let's say Tesla. This means you could use several trading systems on it. For example, you may decide to apply a trend-following strategy for swing positions. You may also decide to day trade using pivots and moving averages. In general, you will have a feel for your chosen market. This is the great advantage. Second question: are you a trade specialist? If the idea of trading one market doesn't appeal to you, then you may want to consider the alternative, becoming a trade specialist. As a trade specialist, you will focus on one trading setup. The setup you choose doesn't matter, you must simply be comfortable trading the system. And you will gain comfort trading this setup across markets through backtesting. Backtesting will allow you to accumulate experience and confidence in your trading setup, to apply it across multiple markets consistently. Experience in trading means exposure to charts, which only comes with trading live accounts, demo accounts, and backtesting. Additionally, to become a trade specialist, you must get comfortable with all the phases of the trade: the beginning, the middle, and the end. The beginning is the most difficult part of the trade. The beginning phase of your trade is when you act as a filter. You are filtering out those subpar trading setups. You, as a trade specialist, must know precisely what those grade day setups look like. This will obviously come from your backtesting. Based on your trading experience, you will know which trades to filter out. This is the most important and critical phase of the trade as a trade specialist. The second part of the trade occurs when you are managing the trade. Does the market provide any critical information about the trade? How do you feel about the trade given the price action that has printed after entering the trade? When the market tells you what to do, make sure you are ready to act on this information. The third and final part of the trade is the exit. Now, your exit strategy is obviously something that is unique and special to your personality. You must simply trade and exit in a way that makes sense to you and fits with your view of the market. Basically, as a trade specialist, you will learn how to discriminate good setups from poor setups. You will learn how to discern if a trade is going well or if it's not, and you will learn how to apply your strategy consistently. Third question: which time frame you prefer to trade? Choosing your market is important, just as important as choosing your time frame. There are three questions to answer when considering the time frame you are willing to trade. First, what type of person are you? Your trading personality will go a long way to determine the time frame that you feel comfortable trading. Second, how much time do you have during your day? Traders who have considerable time to trade may be able to trade lower time frames, such as the 5-minute or the 15-minute charts. But people with very busy days may not be able to trade anything other than the higher time frame. Third, are you a patient trader? Patient traders will be able to endure the inevitable fluctuations in the longer-term trades, but impatient traders find it very difficult and end up trading shorter timeframes. In fact, impatient traders make very good scalpers. Before you decide on your chosen timeframe, remember these two principles. First, the shorter the timeframe you decide to trade, the more intense concentration you will need to sustain to be consistently profitable. Second, as a rule, traders who start out trading longer timeframes and trade those timeframes successfully for months or years have a much higher success rate than those traders who jump straight into the 5-minute charts. So choose your timeframe carefully. Question number 4. What's your risk appetite? The simplest rule to apply is to think about your sleep. If you are able to put the trade on, place the orders in your platform, and then go to sleep, this is a trade size that fits with your risk profile. If, however, when you place a trade, you find it difficult to sleep, you find that you are always thinking about the trade when away from your computer, then the trade is too big. You need to reduce your trade to the sleeping point, the point at which you can place a trade, accept the risk, and have a peaceful state of mind. Number 5. What's your maximum drawdown? Your appetite for risk will help determine the size of your trade, but so will your maximum drawdown. The maximum drawdown is the amount you are willing to lose over a period of time. An easy way to track the maximum drawdown is to look at it from the point of view of one trading week. For example, you may risk 1% of your account on each trade. If you set your weekly maximum drawdown to 5%, you can withstand 5 losing trades in a row. After losing 5 trades, you have hit your maximum drawdown for that week. You may decide to stop trading once your maximum drawdown is hit. How you decide to apply the maximum drawdown rule may depend on the time frame you decide to trade. You may decide to have a maximum drawdown per month if you trade a longer time frame. If you trade shorter time frames, you may decide to have a maximum drawdown amount for one day. It's up to you to decide. Remember that a maximum drawdown will affect how many trades you are able to take at any given time. For example, you may decide to have a maximum drawdown of 5% for each trading week. If you have 6 daily signals on the first trading day of the week and you risk 1% on each trade, you could have a drawdown of 6% if all those trades go bad at once. The implication, of course, is that you should reduce your risk so you are unable to reach your weekly drawdown on the first day of the week. So if you have a 5% drawdown rule per trading week and you have 6 trading signals in one day, perhaps instead of risking 1% per trade, you risk 0.5% per trade. Question number 6. How do you plan to manage your trades? The way you manage your trades is a completely personal decision. There are 2 parts to managing the trade. The first part is managing the entry price. The second part is managing the exit. Both decisions may be personalized depending on the way you decide to approach your trading. Some traders believe that all trading decisions should be made before the trade is triggered. In other words, the entry price, the stop loss placement, and the profit targets are all determined in the beginning, before the trade is initiated. This way, there is no thinking after the trade is triggered. Traders who adopt this philosophy allow the market to rate the trade as a winner or loser. Some traders take this approach because they have jobs outside of trading. Other traders prefer to manage their trades. The trading platforms offer many opportunities for trailing exits, the ability to move a stop loss based on the market action and so forth. But you must know who you are as a trader and what your weaknesses are. If you find yourself doing better, capturing more profits, when you step away to allow your trades to either hit the take profit or the stop loss without your intervention, perhaps you should stick to this hands-off approach to managing your trades. Perhaps you are able to manage your trade successfully and cut your losses before they hit the stop loss order. Choose the best approach that fits your personality. As you can see, there is much more to your trading strategy than simply pressing a buy or sell button. It is important for you to decide not only what you will trade, but also how you will trade it, and to define the precise rules you will use to trade your system. Defining all these variables for your strategy up front will help you down the track when you have to endure difficult times. Drawdowns, losing streaks, and bad luck are all more manageable when you have a well-defined trading strategy in front of you. If you learned something new and found value, leave us a like to show support. Subscribe to our channel and hit the bell icon to stay notified when we upload new videos. Until next time.